Hey everybody, this is Brant from Wolf on Wall Street Trade. The audio on this video is going to be a little funny probably because I'm in a tent right now at a campsite and it's night. You might hear some crickets in the background and stuff like that, but I figured I'd jump on and get a video out to you for this weekend. So first, a couple things. If you like the video, please give it a thumbs up and don't forget to subscribe and hit the little bell so you get notifications when new videos come out. If you have questions or comments, just leave them in the comments section. I always try to get to those and answer those for you. So a quick PSA, I am going to be moving the website. I'm almost done with the new website. So if you are a current subscriber or you become a current subscriber before the new website's open, you'll be grandfathered in at the same price I've had since 2008, but the new website, the price will go up a little bit because my costs have gone up quite a bit since 2008. But again, if you are a current subscriber or you subscribe before the new website goes up, you'll be locked in at that 2008 price and you'll be beating inflation. If you haven't watched my last two videos from the last two weekends, you might want to check them out because I kind of do these as like a running storyline. So it's kind of good to know where we came from last week, what we were looking for the week before that. And with that, let's get rolling. So quickly, in a nutshell, I've been tracking or expecting and tracking some bases that have been forming. In the S&P, it's like a little inverse head and shoulders. You can see it right here. And this is the neckline. In others like the Dow and IWM, it's like a W base. So right here and here, those are your two pivot lows, and here's the neckline. This was our original measured move target, and Dow blew right through that even last week. So some of the things we've seen in this area include like really good market breadth, some of the best market breadth I've seen this year. I'll show you a few charts of that. Some really strong 3C charts. Like here's an example in the SPY. It was coming down here and into September, positively diverging into this little inverse head and shoulders base here. So these are some of the reasons I was bullish on the market and looking for some more upside, which we got in spades this past week. In fact, I can reveal now, because I have to really keep this for my subscribers, my paying subscribers, one of our two upside targets from, if you watched last weekend's video, was 4,000 for the S&P 500. And if we look at this 30-minute chart of the S&P, you can see this week came into it with this little bullish kind of pennant flag or descending wedge, bullish pattern, and hit that 4,000 mark on Friday. So that is one of two targets. There's one more a little bit higher, but we had just a monstrously strong rally after the CPI report this week. And what I've been saying the whole time to my subscribers is for this rally to really have legs, what we need to see is rates come down. The dollar had already gone into consolidation. It was supportive, but we needed to see rates come down for the mega caps to participate and to lead. So they really did that this week. So here we're looking at a 60-minute chart of the 10-year yield. You can see this big uptrend. This has been just decimating the mega caps. And what I said was that we needed to break this trend line, this short-term trend line, and break below 4%, which is right there. That happened after the CPI report, and the mega caps led. This is the largest one-day drop in yields since 2020, actually since March of 2020, which is just the tail end of that whole COVID crash that we had. And why did yields come down? Because the CPI, the Consumer Price Index, came down on a year-over-year basis, and it came down pretty big. Total CPI came in at 7.7 from 8.2% on a year-over-year basis. And core CPI came in at 6.3% versus 6.6 on a year-over-year basis. So what that is telling us is it seems like the pace of inflation is starting to moderate. The Fed had already expressed before the CPI report that they were looking to step down rate hikes from 75 basis points to 50. So this report makes that a virtual certainty. So I believe right now the market is pricing in, as of Friday, 100% probability of a 50 basis point hike. And the day before the CPI report is only 58% for a 50 basis point hike. So it came in dovishly. And the Fed terminal rate came down by 25 basis points. So the market is basically looking for the Fed to hike maybe 2 more times, 50 basis points each, another 100 basis points, however that comes out. It could be a 50 basis point hike in December and then 225s. In any case, it's more dovish than the market expected. And this sent stocks soaring to their best week since November of 2020. So you can see just monstrous move here Thursday in the S&P, even bigger move in the NASDAQ because those mega caps were participating and leading. The NASDAQ 100, which is packed full of large cap tech, had almost a 9% gain on the week, and I think it was its third best day, Thursday, third best day since 2008. Thursday had the largest short squeeze on record, and Goldman's most shorted index saw the biggest 2-day squeeze in the entirety of its history. Now, what's really interesting, and I think I had this in last weekend's video, was that NASDAQ really wasn't looking great. It was really underperforming. Its 3C charts weren't looking great until about a week or two ago. All of a sudden, NASDAQ or QQQ's 3C chart looked the best by far. It was nearly going parabolic. Let me pull that up. I wish I could get some more history on this chart, but you can see as the NASDAQ price is pulling back over here, 3C is going parabolic. And this was happening, I think, if you go back to last weekend's video, maybe even the weekend before, I was showing this. So this was telegraphing that the market was really ready to rally. It just needed that catalyst. It needed yields to come down, and the CPI report was exactly that. So you can see prices caught right up to where 3C was. It was leading positively here. Price caught right up to it on this week. What I do is watch the mega cap index, MGK, and I watch how it performs against the equal weight S&P 500. And in the past couple weeks, it's either been underperforming or a couple days it'll be up 30 basis points above the S&P, oscillating back and forth, up 300 basis points against the S&P equal weight index. So that's showing that the mega caps really pulled their weight this week as yields came down. Now the NASDAQ, it has not hit our measured move. As a matter of fact, it's just breaking out of its base. Let me pull that up. So here's the NASDAQ's base right in here, just breaking out. So it has a lot more room on the upside. I don't know if it's going to make that measured move or not, but it does have a lot more room on the upside. And if these mega caps keep leading the way they are, they'll lift the whole market. And I'm still looking for the S&P to move higher than that 4,000 target. That was the first of 2 targets we have. And we had a lot of bullish signals too. So one of the ones I watch, there's a few sectors and a few averages actually, like small caps that tend to lead the market. So for the technology sector, semiconductors tend to lead the technology sector. So when you see semiconductors outperform, that's usually bullish news for the tech sector. And I'm going to show you real quick. This is a normalized chart as of this point over here, which I think is the 17th of October. So this is XLK, the tech sector, in the green and red candlesticks, and this is semiconductors in blue, the SOX index. You can see this huge outperformance here. So this is a very, very bullish signal. We're getting the same thing with Dow Industrials. Dow Transports tend to lead the industrials, so we're seeing the same thing there. And here's that chart. So this is Dow Industrials in the candlesticks and transports in blue. Normalized. Look at the leading here this week. So that again is a bullish sign, even though the Dow has already smoked and blown through our measured move target. Again, these are bullish market signals. Gold had a really great week for 2 reasons. Both are the same reasons stocks did well. The dollar came down, yields came down. So this is GLD. Does this look familiar to you? Look at this huge move this week, and I'll show you. This looks like a W base. Now watch, I'm going to overlay the S&P. And here's the S&P in this fuchsia kind of color. This is very interesting because the S&P is a risk asset and gold is typically a safe haven. Look how closely they're tracking together. It's because they're being driven by the same 2 dynamics, the dollar and yields, both inversely. So when the dollar and yields move down, stocks do better, gold does better. It's a interesting time. I'm going to keep the gist of this video kind of short because the gist is I think the market has more upside to go, and unfortunately the bond market was closed on Friday for Veterans Day, so we didn't get the signals from the bond market. But what I want to show you is what the dollar has been doing and what Treasuries have been doing, because they're both reflecting the same thing, and that's basically what the market is pricing in as far as the Fed goes. So what I have here is the 10-year Treasury future. Remember, yields move inversely to Treasury prices, and then in blue I have the dollar index, but I've inverted that. So basically this is dollar weakness, and this dollar weakness here suggests that yields have further to fall, Treasuries have further to rise, and if that's the case, stocks do as well. But this is suggesting, this dollar weakness is suggesting that yields come down more, and it's very supportive for the equity market. Let me just pull up a little different chart here and I'll show you that. What I'm going to do is just put in S&P futures. Now you see the dollar leading lower. This is the dollar weakness. Remember, the price is inverted. So it's basically creating room for stocks to move to the upside. And yields are doing the same thing. And what the dollar is suggesting is that yields have further to come down. If we look at Treasuries, and this is the 10-year Treasury, and the blue line is 3C. So look at this positive divergence going into and before the payrolls report, or I'm sorry, the CPI report. Here's the CPI report. Look at this huge volume. So 3C was already leading higher, and this is a bull flag over here. So this suggests that Treasuries should go up a little bit more and yields come down. That again is supportive for those mega cap stocks in the NASDAQ 100. Whenever the mega cap stocks do well, most of the indices do well. Not small caps because they don't have exposure to them, but the S&P does, the Dow does, but the NASDAQ will get the most bang for the buck out of mega caps going up. So this looks constructive. Little consolidation going into that holiday on Friday for Veterans Day for the bond market, but this looks like a bull flag. And like I showed you before, the dollar is suggesting that yields should come down further. Dollar's creating space for equities to rally more. As a matter of fact, let me show you the dollar. Because as of last weekend, I said it's in a consolidation. And that's all we need from the dollar, is to consolidate for stocks to be able to rally. Let me go out to a little bit longer chart here. So I said the dollar is in consolidation. So this was the dollar in consolidation. This is the CPI report. This is no longer consolidation. This is a breakdown. This is why stocks did so well this week. One of the reasons why this is a barometer of how tight the Fed is or how loose they are. And this may end up being a really pivotal moment for the dollar. It's been very strong. If you watched my video last weekend, I talked about the Fed being worried about breaking the financial system by over tightening. And we got a lot of comments from Fed officials this week saying exactly that. So I'm not so convinced they want the dollar higher. They do want financial conditions tighter, but they don't want a financial crisis. Here's a broader look at the dollar on a daily chart. And this is why I'm saying this may be a really pivotal moment, because until this moment, what we had was a trend of higher highs and higher lows, an uptrend. Now we have a lower low. This may be the start of a topping process in the dollar. Since stocks have had such a strong inverse correlation, they would love that. But remember, in last weekend's video, I said I think what we're going to see is the market start to move more sideways. Move up, yes, that's what we were looking for. Still have a little bit more to go, I think, but more sideways than a primary downtrend. I don't think it's the end of the bear market, but I do think we could see the market turn into this large lateral choppy range, perhaps for the rest of the year. And gold would love to see the dollar break down. So real quick, I'm going to do another comparative chart here. I'm going to pull up S&P futures, and I'm going to put that inverted dollar back on the chart here. So this is in no way meant to be a forecast. It's just meant to show you how supportive the environment is. The dollar, again, this blue line, and it's inverted, is trading at levels over here when the S&P was last at 4,300. So that is how supportive it is right now, the dollar weakness for stocks. Market breadth is still very strong. And really, the market has been able to hold up without the mega cap support until this week. So now the mega caps are just starting to come in. They're heavily weighted. A half a dozen of those stocks can move the market more than 1,000 NYSE stocks. And to illustrate that, what I have is the S&P 500 here in the candlesticks. And this white line is the percentage of NYSE stocks that are trading above their 200-day moving average. You can see how supportive this has been. And if you look at this, it's trading at levels, let me pull up this different pointer, that we last saw back in January when the S&P was trading at 4,600. Again, that's not a forecast. I'm not going to make a forecast based on a breadth indicator, but what I'm telling you is there is a lot of strength in this market right now. I'm not going to go into all the craziness with cryptocurrencies this week. I do cover that though for my members, but what I'll say is I have not liked Bitcoin, the price action, for quite a while. This is Bitcoin futures, and if we zoom in here, I'll show you it's been in this range, right? And this is what we saw this week with this whole FTX exchange meltdown, that whole nightmare that's going on. Would not want to be in crypto right now. In any case, it broke this very lateral trend that it's been in since June. That is not a good look, and I have go to my Twitter and look at my posts. I've been saying for quite a while I don't like Bitcoin. I can see the potential of it losing 10,000 points from breaking down at this area. I don't think I would want to be in that. As a matter of fact, last week the chief of Binance, the biggest exchange, basically said that the crypto industry's troubles right now are on par with the financial crisis of 2008. This is the chief of Binance saying this. I'm just looking at the price and saying I don't like this. You know, this breakdown here and a back test into it that failed. So that's all I'm going to say about Bitcoin for right now. But not one of my favorite assets. And I'm not a crypto fan or crypto naysayer. I have traded it on the long side. I've done well with it. I have not liked it for quite a while though. So again, I can reveal that the first target of ours at 4,000 was hit right on the nose on Friday. It's amazing how price, if you understand what price is doing and you understand the price patterns like these bull flags, the measured moves from these things are just phenomenal. As a matter of fact, the measured move for that 4,000 level came from this bull flag right here. 4,000 right on the nose. I do think the market has maybe run a little bit too far, a little bit too fast, and I would like to see what the bond market does when it opens on Monday, get that signal from the bond market. I would like to see the market consolidate here. The S&P could come down to 3,900, draw in some new shorts, consolidate the gains, shake out the weak hands, and then again we do have a higher target. I can't reveal that for members. You know what it is, but when we hit it, I'll let you know. I do not think that this is a market bottom or anything like that. This is a counter trend bear market rally, in my opinion. I do think we'll see new lows probably going into next year. But right now, this is a market that's on fire, very strong. The mega caps are doing what they haven't been doing for months, and that's leading. And that just started. So we saw a huge short squeeze. I think if we get a little consolidation, shorts will jump back in and they can power the next move up. But I would like to see that consolidation. I don't like to see stocks go parabolic. I like to see them advance, consolidate, advance, consolidate, advance, consolidate, advance. You're building structure, you're building support. So this was former resistance right here. That should be support. So if it came down to 3,900, fine with me. But I would like to see that, and I think we will see that probably going in the next week or so. But I do think we have more upside still to go, and when things turn around and things don't look great, I will tell you that I'll be short this market. I'm not a bull here. I'm not like a perma bull or a perma bear. I'm just looking at the objective evidence and looking at the probabilities. And we have been looking for this rally ever since we got the evidence of a base forming here. And again, remember 3C and the SPY was just shooting way higher in this area. And this is the area I'm talking about. If I could show you more chart history, I can't. This is as far as I can go back. But you would see 3C just trending down with price actually leading it lower until this area. This is 3C showing accumulation, showing a base forming here. That's a positive divergence. This is what was driving all of my analysis, saying I think we have more upside to go. I think we're forming a base in here. Not a bottom, but a base. And I think we have more upside to go. And then, like I said, if you saw last weekend's video, and I think even the week before that, I showed QQQ and I showed this monster divergence. Look at price, what it's doing here. It's coming down, and 3C is going nearly parabolic, and the NASDAQ blew every other average away this week. Almost 9% on the week. Huge week for the NASDAQ 100. And again, go back, watch last weekend's video. You'll see me talking about this huge parabolic divergence well before this move even started. So that's what 3C does. Some of you have asked about it. It has the power to contradict price. If everything is normal, it should track with price. When price is going down, 3C is going up, that's showing accumulation. When price is going up and 3C is going down, that's showing distribution. It is a money flow indicator. I get a lot of questions about that. I think it still looks very strong, even though price has caught up to that leading divergence, but there's no negative divergence here. So I think we can see more upside. I would like to see that consolidation, and I'm going to leave it off there. I hope the crickets in the background didn't bother you too much. And I'm going to turn in my little tent here and have a good night's sleep and get this video out to you. Have a fantastic weekend, everybody.